What most consumers understand is as rates go down, values go up. I wouldn't say that's true this time.
My name is Aaron Pearson. I am the Vice President of Marketing and Growth here at JMG, and I'm here with our CEO and founder, Jason Mitchell, who's obviously America's #1 real estate broker. You have #1 designations in a ton of different areas.
Yeah, a lot of them are probably not true.
Well, I don't know. It's recorded online, so it's got to be true.
Yeah.
But, I'm really excited to have this conversation. There is a lot of things happening in the landscape of real estate. What do you think agents should be aware of right now?
There's a lot of macro things going on that impact a lot. We're running into some good tailwinds with rates being cut 50 basis points. The consumer environment and hearing that speeds people up because what most consumers understand is as rates go down, values go up for the most part. I wouldn't say that's true this time. I don't see values going up significantly. I see inventories continuing to rise, and I see an accumulation of consumer debt that's almost at $18 trillion, which impacts the ability for homeowners to tap into their equity, I think is going to diminish because I think banks are going to cut back on the ability to borrow at the current levels that you can borrow, whether that's 80% LTV on a cash out, 85, whatever it's at today. I think that gets cut by like 10%. And if that does, that's going to really minimize the ability for people to pull out money to pay off their credit card debt, which a lot of people are in, as we know. It's going to force sale. So I think inventories continue to go up, and I think the pace of inventory going up is going to outweigh the buyer demand while rates try to trend down. The good news is that we're going to have a stable market, in my opinion, but I don't see pricing taking this like huge leap. Now, I could be wrong, but I truly feel we're going to be in a really good environment for real estate professionals because come Q1 of next year, if all things stay true, as rates continue to tick down, but inventories continue to rise, it should be a really healthy spring market through Q1 and going into Q2 because rates will continue to trend down. And if we can get interest rates in the low 5s to high 4s, then buyer demand will pick up, but you're still going to see people, two sides, one forced sale because they have to. And then the other side is there's a lot of people that you probably know too, Aaron, that for the past 3 years, they've been wanting to sell their home, but they weren't going to trade their 3% interest rate for an 8%.
Totally.
I mean, would you trade the interest rate in your home?
Absolutely not. No, I have a 2.5% I bought in 2021.
Right.
People are begging to take over my loan.
Yeah.
Right.
So as the mindset, as rates go up, the mindset is that's crazy, that's crazy, that's crazy. You go from 2.5%, 3%, then you go to 5, then you go to 6. Everyone's like, that's crazy. Then 7, that's nuts. And then you get to 8, like we got to, and people are like, wait, what is going on? Yeah. I'm never going to sell my home. So that impact going up is different than the psychological impact coming down, which is 7, still high, 6, palatable, 5, interesting. Yeah. Will I trade a 3 for a 5? Probably. And so you're going to see people selling that had been wanting to sell and now can justify the basis for selling because they're going to exit into a new residence and not rent. But you're also going to get a lot of people that sell that go rent because they're not going to have the down payment requirements because their equity's been tapped. And I think it's happening to a lot of people right now. I think it's something that isn't being talked about enough. I think debt's being talked about enough, but I don't think the ability for a repurchase once selling an asset is being talked about enough because there's so many people that they can't tap into credit card debt anymore. They can't get a home equity line. That's going to tighten up. And when those credit lines start to tighten, that's when the domino effect occurs. And then they're forced to sell. So there's going to be good listing opportunities, but there'll be a decent amount of buyers behind it as well. So I do think that the light at the end of the tunnel, we're getting to it. It's going to be a better market. So that's really good news. I think purchase origination picks up in the loan space significantly. So I think banks are going to start doing well. Lenders are going to do better. I mean, when you look at a lot of the big lenders that are hiring hundreds of loan officers, these people are a lot smarter than me, and they have the right economists to predict this is what we anticipate for next year. So you got to ramp because hiring somebody isn't just putting them in a chair. You got to train them for months. And the term even last year was used survive till 25. And so agents need to be prepared for that and prepare the right way that there's going to be increased competition as well.
So do you think that it's important for agents to know how to help position their buyers in a way where they're making financially sound decisions?
I don't think it's a real estate agent's responsibility to talk about fiscal responsibility. That's what accountants are for. That's what financial advisors are for.
Yeah.
And I think the more that real estate professionals try to act as if they understand all these things, it kind of opens the door to potentially sound really foolish. But also, I think educated buyers would understand, like, I know my financial situation better than you. Why don't you just focus on helping me find a home? Like, The reality is, as real estate professionals, what you need to do, it's very simple. Follow up. Most don't.
Right.
Just pick up the phone.
Yep.
Pick up the phone. It's amazing what happens when you pick up the phone. Now, foreshadowing opportunity on missed opportunity in the housing market is something we definitely should be talking about. In that sense of, if we believe that appreciation is going to occur as interest rates go down, which is the narrative, which again, I I don't quite believe that. Last time I did, and I was dead on, of course, but that didn't take a genius. When rates go to 2%, pricing's going to go up. And also, supply is the main factor of pricing. Nothing more, nothing less. It's supply. Month of supply is what I usually look at as an indicator of appreciation. There are more canceled listings this year than there has been in 3 years. There's longer days on market. That's indicative of the current environment. The only thing that matters when you go to sell your home is what's my competition. It doesn't matter that Joe, my neighbor, sold his house for $400,000. Joe's house sold 3 months ago.
Right.
Show me what else is going on in the neighborhood, and I'll tell you where your home might. Now, you might not like that discussion because your home might be worth as much as Joe's, and you have a pool, but I can't control that environment of what's active. What is my competition? Agents should be talking about what is going on while we list and what's upcoming, not what's in the past.
Sure.
The past doesn't matter.
Yeah.
Because it works in the opposite direction too. When Joe's house sold at $400,000 3 months ago, but now there's only one active home listed in the community of 500 homes, guess what? There's a demand there. So even though your pool might give me an extra 20K value, let's list it at 450 because there's nothing else on the market.
Sure.
And so it works both ways. Listings are about the future. It's not about the past.